Welcome back to Financial Fortitude. I'm Michael Acosta, joined as always by my co-host, Brady Hemmerly.
Today we're tackling a topic that few investors have heard about, but far fewer actually understand: structured notes.
And honestly, that confusion makes sense. Structured notes can sound extremely complicated, overly technical, and sometimes even controversial depending on who you ask.
But at their core, structured notes are simply investment tools designed to solve a specific problem.
Exactly. Some investors want downside protection, some want defined outcomes, some want exposure to the market without taking full market risk. Structured notes attempt to create customized risk-reward trade-offs for every investor.
So in this episode, we're breaking down what structured notes actually are, how they work mechanically, at least the basics, why clients may consider using them, and where they may or may not actually fit within a financial plan.
And importantly, this is not an episode saying structured notes are good or bad. Like most financial tools, they have strengths, weaknesses, and appropriate use cases. Let's dive in. Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We are your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in. Well, Michael, I'm excited about this episode and then perhaps some future episodes because you and I have been talking through this as an episode, as an introductory, I would say, education session to what is going to hopefully be a mini-series. When it comes to the world of investing, I think a lot of clients or listeners are very familiar with stocks and bonds and mutual funds, ETFs, more traditional portfolio pieces. But I would say fewer clients have heard of, understand, know what a structured note actually is. So our goal through this entire episode is let's introduce the topic for anyone who hasn't heard of it. And then in future episodes, let's expand on the topic and actually presenting more specifics about how they work, where they fit, all of those things. So interesting to say the least. I would say high level, we're just walking through, hey, for those who haven't heard of it or have never really explored it further, where do they fit?
Yeah, of course. And I like to think about if I'm going to be doing some sort of home renovation, I know that I can go to my local Lowe's hardware store or Home Depot, whoever it might be, and there's going to be a large warehouse full of different tools and materials and supplies for any project under the sun. Well, when it comes to identifying investment tools or solutions that could make sense for your financial plan, I won't necessarily say that the universe is endless because it's not, but you need to be aware of what's available because, to your point, for specific projects, home renovations, you're going to need specific tools. You can't use the same tool to do all home renovations.
So let's begin to dive into it. Can you share with us, I'd say, a more formal definition as to what a structured note actually is? And then, depending on the complexity of that definition, maybe you and I can break down what it actually means.
Yeah, you're speaking my love language because you know that I love the technical side of things and to be, as detail-oriented as possible. So I'm going to go over to Investopedia, which is a great resource when breaking down financial jargon and terms. So this is a article, blog post that Investopedia put together, really just breaking down what a structured note is. And so they've provided a definition of a structured note is effectively a debt obligation that also contains an embedded derivative component that adjusts the security's risk-return profile. Now, the return performance of a structured note will track both the underlying debt obligation and the derivative embedded within it. Now, when I say that out loud, it just screams complexity, right? If I am a novice at investing and this comes across my inbox or on my social media scrolling screen, I'm probably moving past it. And the downside is that this could be something that very well works well for me as a component or a complement to my financial plan. For others, it may not.
So let's just break this down into simpler terms for someone who looks at this or hears this and says, structured note seems really complicated, not for me.
So I like to equate it, and again, this is my observation and my opinion, I like to equate it to a certificate of deposit or a CD. Okay, now it's not exactly like that. Why? Because there's different risks and trade-offs associated with it. When you think of a certificate of deposit, a CD with a bank or an issuer, you are effectively giving them a sum of liquidity, a sum of your assets, in exchange for a promised or predictable yield or interest or return. Okay. Now, when you give the funds over to the bank who's issuing the CD, they get to keep that for a specific agreed upon time frame, 12 months, 18 months, 24 months, 60 months, depending on what you're agreeing upon within the issuer contract, right, or agreement. Now, in exchange for that timeline of where the bank or the issuer gets to keep those funds, they're going to offer you a predictable yield or interest for over that period of time. As long as you hold on to that CD, you don't relinquish ownership or surrender it early before the maturity date, or the issuer doesn't call it back to them and give you your principal contribution back, you can expect to clip those coupons or receive the interest based on a monthly, quarterly, semi-annual, or annual frequency. Now, certificate of deposit CD, in my opinion, is a lot more conservative in nature compared to a structured note.
Got it. So what I'm hearing, structured note, not a CD, but somewhat looks or feels like one, because what I'm essentially doing is giving up access to my dollars when buying a structured note, and then effectively leaving that structured note in place based on the timeline that's been defined by that note and the terms essentially dictated by that note.
Correct. And now some of the attributes or characteristics or features that you can include or expect to see on a structured note that you wouldn't on a CD are going to be participation rates, earning caps or growth caps, buffers on both the principal contribution as well as the coupon itself if it's an income note versus a growth note. So again, there's different features, there's different things that you need to be mindful of, there's different trade-offs and benefits, but ultimately what the purpose of the note is, it's more customizable per the investor. We're ultimately trying to define the outcome and the experience in a manner that aligns with the investor's risk appetite and ultimate objectives, right? Whether it's going to be growth oriented, whether they want more downside protection while being invested into the market, whether they're looking for additional income outside of just the 4% distribution strategy or model that a lot of financial advisors will use, compared to an annuity, whatever it might be. The other thing is that with the structured note, it's typically going to be tied to 1, 2, 3, in many instances, underlying indices. Things like the S&P 500, the NASDAQ, the Russell 2000, the NASDAQ 100 Tech, the Euro Stock 50, right? So the performance or the outcome of the overall structured note is somewhat dependent on the underlying indices as well as where markets move throughout the course of the year. And we're going to break some of this down.
Got it. So to summarize, what I'm hearing is the purpose of a structured note at its core is to essentially engineer or design a range or an expected outcome using market indices, but without directly investing into those indices like I would in a stock portfolio or a bond portfolio.
Yeah, I would say a great simple analogy aside from the CD one that we've given up to this point is think about if you were to go into a pizzeria and you wanted to build a custom pizza instead of ordering something directly off the menu. What do I mean by directly off the menu? Directly off the menu might be going out and buying ETFs or mutual funds or individual stocks or individual bonds, whatever it might be. This is, in many instances, combining all of that together to try and create a certain level of experience with the toppings that you're putting on the pizza that you're creating in a custom manner.
So I guess my question to you, why haven't I, if I'm a potential client, why hasn't someone like me heard of this before? Is this a brand new thing?
So I wouldn't say that it's necessarily a brand new thing. I would say that more often than not, it feels more complicated and sophisticated in nature. So it may deter investors away. Maybe not all advisors have access to these types of solutions. More often than not, I would argue that you're going to see them in brokerage-like environments. So any sort of brokerage firm. And they are typically commissionable or commission-based products. More often than not. They do have some advisory-based fee-only ones, but more often than not, I would say they're probably commission-driven.
Got it. I think some context for a lot of our listeners is these type of strategies are not new. Wall Street has been effectively employing strategies like this at much larger institutional scale for years and years and years. And it's only been, I wouldn't say recent as in like brand new this year, but only more recently that retail investors like you or I have access to solutions like this at a smaller type of scale, right? Effectively, what a bank is doing here is they're putting money into a bond-like component, writing options on each side of that bond. And the purpose of those options are to either magnify potential growth, provide a safety net on the downside, right? The bank itself is just effectively building a complex set of pieces together to create a more simple, packageable piece that someone like you or I can actually invest in. So not a new strategy, just more newly available to the retail space rather than huge banking spaces, at least the observation that I understand.
Yeah, correct. And I would even overemphasize that when it comes to the structured notes in general, they're not designed specifically to beat the market universally. They're more so designed to, again, alter the investor's experience and complement what the core components of the financial planner, the investment management strategy actually looks like.
So let's talk about some basic components here because listeners have got a definition from us. They kind of understand I'm trying to build a custom experience. I've heard a lot of new terms here. What does this stuff actually mean? So let's take some of those basic components. You mentioned indices, buffers, caps, terms, like just walk through either an example or how some of these things work, and then we'll be able to actually sketch out a few more specific examples or at least details.
Yeah, so let's just do a basic note. And again, this is more so if I'm going to design the persona of the investor, it's someone who wants to participate in market-like returns, but have some level of guardrails associated with their investment journey or solution. Okay. So in this basic structured note design, I'm going to use very simple indices. So let's just say it's a structured note that has a 1-year term. Okay. So think of it like a 12-month CD as an example. The ultimate result of the note is going to be tied to how the S&P 500 indice performs from start to finish. It's a point-to-point solution or strategy. Okay, so I enter into the note on day one. The S&P is priced at X. When it matures at the end of the 12 months, S&P is either going to be positive or it's going to be negative. I get to participate, which is why we have a participation rate, up to a certain level of what the underlying indice provided during that period of time, point to point, again, 12 months. Okay.
So I think important thing to note here is I'm not investing in the S&P 500.
Nope.
I'm putting money into a note and its return is tied to or linked to the S&P 500. Is that correct?
Absolutely. So you're giving the money to the bank who issues it. The bank is using that money and they're providing some level of return based on the underlying index or performance of the S&P. Okay. Now, depending on your term, whether it's 12 months, 24 months, 36 months, 72 months, could dictate what your upside potential looks like. Okay, and this is where cap rates come in. So for this basic note, let's just say that you have a 12% cap over that 12-month period. That means from start to finish, you could generate up to 12% growth on the dollars that you gave to the bank or put into this structured note. Okay. Now you're going to be capped at that. So if the S&P from start to finish is up 13%, you're only getting 12. If the S&P 500 is up 10%, you're getting all 10, right? Because they're capping you at that 12%. Now, one of the biggest arguments would be, well, why wouldn't I just invest in the S&P index directly, right? So that I'm not capped. Well, this is where the element or the addition of the buffer comes into play. And this is a principal buffer. So let's just use an example of 10%. This means that if the underlying index, which in this case is the S&P 500, from start to finish is cumulatively down 9%, I am within my buffer. Therefore, I do not participate in any loss. If I put $100,000 into this note at the beginning of the 12-month period, S&P's down 9, I get, in theory, $100,000 back. If the S&P 500 is down 12%, well, this is where it gets a little bit more technical and into the weeds of, well, was it soft protection or hard protection? If it's hard protection, you lose 2%, right? The 2% above the 10% buffer. If it's soft protection, once you breach that buffer, you participate 100% in that loss. So you would have lost 12% at maturity.
Got it. So this is where this concept of trade-offs start to come into play, right? I have to trade off the access to my money from a liquidity standpoint for a year. I have to commit to being in the structured note for the entire year. I have the potential to make up to 12% as long as the return of the underlying index performs in that capacity. And I have the protection of at least 10%, right? That is the trade-off between the limited upside is I have protection on the downside. And depending on the experience of the market at the finish line, that is the return that I'm going to capture, whether it's at the cap, above the cap, at the protection, below the protection, etc. So you can start to see here for investors considering this type of strategy, there's an engineered design here. An investor is never going to make 20% in 1 year from this investment because it's engineered to cap out at 12, as an example.
Correct. Now, again, if the idea, like a use case, well, why would I do that? Well, one, on a year-to-year basis, the S&P historically could drop 12% on average in any given year. So this does help buffer that to an extent for someone who is wanting to get higher potential returns than just sitting money in bonds or high yield savings accounts or CDs. Maybe it's money that I'm going to put towards the down payment of a home within the next 12, 18, 24 months. And I want to participate in higher potential returns, but I want to offset or mute some of the potential market risks. This could be a viable option because maybe instead of using a 10% buffer, you're using a 15 or 20% buffer, right? Based on the overall probabilities of outcomes. So let's look at a different scenario. Let's say that we have an investor that has a longer time horizon. Okay, maybe they want to complement their strategy. They recognize that the markets have been trading at just about historical highs, and they want to still participate in S&P 500 like opportunities, but maybe they want to try and de-risk some of the outcomes with a small percentage of their overall investable assets. Let's say they're working with their financial advisor and using that customized pizza type of a metaphor, they're trying to pick and choose the elements of their structured note. Let's say that, hey, it's an S&P 500 index. We like that index. We feel most comfortable with that index. We are fine setting this money aside for 5 years, right? 60 months. Let's say that the buffer is a 20% buffer on the downside, but instead of it being a 12% participation rate on the upside, because the bank gets to hold your money for more than 12 months, it's 60 months, they're offering you 150% participation rate. What does that potentially look like for the investor if we look at the historical average returns of the S&P over the last 5 years?
Yeah, so let's talk through that. I think the first key, at least to understand, is that, as you mentioned, I'm giving up my money for those 5 years. It's not that I can't ever come back and get it, but if I want to remain in that set of defined outcomes, I have to make a trade-off with the bank that says, hey, my money will be here for the entire 5 years to actually capture all of the outcome itself. So if I put my dollars into the structured note that's linked to the S&P 500, and let's assume that I gather average returns year by year over the course of that 5-year period. An average S&P 500 return that at least we pulled is 12.58% per year.
Yep, and that's coming from Morningstar.
Got it. So let's say I get 12.58% per year, and I get it for 5 years. Very simple math, 12.58 times 5, is I'm effectively getting 62.9% total return, at least from where I started on day one.
Yep, cumulative.
Yes, yep. Now, unlike the prior note that had a cap on the upside, this note, at least as you've mentioned, it does not have any cap. It rather has a participation rate, uncapped on the top. So I'm receiving all of the return that the underlying index is providing. And what you've shared is, hey, I've got a 150% participation rate. What that tells me is if I take my cumulative return, 62.9, and multiply it by 150%, or 1.5 for simple math, my cumulative return in that particular note would be 94.35% cumulative over the course of those 5 years. I've had to wait from day one to all the way to the last day to actually see that return credit. But as you've mentioned, I'm getting that upside potential. I'm seeing some magnification benefits, which I talked about before, why the big banks would tie an option around any type of piece like this. And I have still the downside protection if the market trailed the other way, right? That would be the other component. If I was not receiving market averages and the market took a big dive or perhaps slowly was stepping downward each year, I'd have that 20% buffer to lean on.
So in theory, when it comes to structured notes, what's happening in between the lines, and what I mean in between the lines as far as the start date and the maturity date, for some notes, not all, is almost not really relevant because it's about the outcome of from where you started, right? From day one of entry to when the note matures, because it's a point-to-point solution. So in this case, again, I think it accomplishes the goal of the client who's got some hesitation around all their money being directly tied into some market risk or into the market as a whole. And the presence of that buffer allows them to eliminate some of their overall risk as well as their overall psychological or emotional concerns. Now, of course, there are trade-offs, and it's important to emphasize that buffers do not guarantee the elimination of losses, as well as the trade-off here of, okay, well, these funds have become illiquid to me for at least 60 months. So this is where, again, you have to understand what are you ultimately trying to solve for and what are your trade-offs, because if you're not okay with having this money set aside for 5 years, then it's not a strong solution for you. It's not prudent. It doesn't make sense. But what you're getting in exchange for allowing the bank to hold your money for those 5 years is the 150% participation. So again, for someone who was just directly invested in the S&P in that scenario, 62.9% cumulative over 5 years. If you give the money to the bank in this scenario with the structured note, they're crediting 94.35%. That's a pretty sizable difference in potential outcomes.
So using those two examples, we've got a shorter term note. It's got some caps on it. We're really trying to constrain or define our outcomes. We've got a longer term note. There's not nearly as many caps on it. We're looking for potential upside or magnification benefits. Let's go into some common use cases or potential ideas on where these notes can fit, and I'll emphasize here as a complement to our overall strategy. What do you see more often regarding like how and when these ideas start to get implemented?
Yeah, I would say some of the most common ones that we come across are clients who are nearing retirement and or are already in retirement, and we're trying to accomplish a couple things. One, reducing sequence of return risk, right? Taking money out of our investment portfolio that's a combination of traditional stocks and bonds through what could be volatile times or periods of expansion in the markets. So again, just trying to reduce sequence of return risk. Also, for those individuals nearing retirement or in retirement that are concerned about market drawdowns, but also want participation without the full exposure. So think about someone who goes out and purchases a timeshare as opposed to someone who goes out and buys an investment property and manages it themselves. The person who participates in the timeshare, I'm not saying that you should do this, but who purchases the timeshare likes to be able to participate in visiting a location or a type of resort, at least on a recurring basis, right? They like to get away, they like to have their space, but they don't have to deal with the same experience of the maintenance, the management, and everything else that comes along with owning the property directly themselves.
So what I'm hearing first and foremost is really employing a buffer is a protection type of measure within a portfolio where protection starts to make an impact from a sequencing standpoint. If I'm close to retirement, my portfolio is as large as it's ever been. I don't want to step into the first year of retirement and watch my portfolio begin to draw down with the market. Having a buffer or defined protection outcomes in place may help improve what my overall plan looks like. Do I have that right?
Absolutely. The other individuals or clients that we tend to see, and I'll kind of just chime them off and then we can break them down individually, would be investors or households that have concentrated cash positions, as well as high income earners that are looking for other ways to invest and diversify their high cash flow that they're putting into their balance sheet. And then lastly, just for those who are seeking behavioral management.
So let's talk about the first one, concentrated cash positions. What do you mean here? Where is this actually applicable?
Yeah, so just recently we were meeting with a physician who had recently, over the course of the last 9 to 12 months, stepped into an attending role and have income 6x'd, right, from when they were in training to where they are now. Well, over the course of the last 9 to 12 months, by way of implementing the command account infrastructure and just having this organic accumulation of excess earnings, they have a sizable amount of cash on hand. Now, there is such a thing as having too much cash and that being a bad thing if it does not have purpose. So in this scenario, this could be a way for them to deploy a percentage of that excess cash into the markets, because this individual may have some nervousness about deploying the full lump sum amount all at once because we're trading in the market at historical highs. Maybe they are a novice at investing altogether, and so they don't feel comfortable with the ebbs and flows, the turbulence, the volatility that comes with the market. So it's more of an individual who's seeking a staged market participation because of the guardrails or the buffers, right? The buffer's not necessarily guardrail, but you could use it metaphorically in this scenario if you're thinking about someone who's going bowling for the first time. You put the guardrails on there so that you don't throw a gutter every time.
Got it. And I would chime in further on that point as you mentioned the scenarios. Hey, I've moved from resident to attending. I've got all of this extra cash that's piled up. Where I'd argue we see this just as often as I'm 55 to 60. I have just slowly but surely been accumulating cash for the last 10 or 15 years, and I've got 200, 300 grand sitting in a bank account, and I've just never really been in a position where I feel comfortable just dumping it into the market. But
Right.
I want more, right? Like, hey, I know the bank isn't providing me anything. I just don't know where or how to get in, or I don't feel ready to get in. Like you said, having that guardrail in place can make it feel at least more comfortable to step across the line with however much money fits within the overall plan itself. So we noted clients nearing retirement, beginning to really examine this concept of sequence of return matters. Guardrails are helpful. We've talked through clients with concentrated cash positions who perhaps are a little apprehensive of jumping across the line or dipping their toe in the pool. You also mentioned high income earners. Talk to me more there.
Yeah, so these are individuals who are already taking significant risk in their businesses that they may own, or maybe even their career, right? Maybe they're fully participating in their employer-sponsored retirement plans, they're maxing those out, and they're wanting to identify opportunities for smoother investment experiences from a psychological standpoint. So they recognize that most of their investments being tilted towards stocks as opposed to bonds come along with, yes, greater upside potential in theory, but it also ties into greater potential volatility or turbulence as far as market valuations day in and day out. So this is a way to diversify, hedge, or smooth out the potential outcome of cumulative return across your entire financial balance sheet. And from a psychological standpoint, it can be what I would consider more of an enjoyable experience or ride, because you're muting some of the drastic downturns depending on what your buffer design actually looks like.
So again, very similar. We are looking to limit potential loss on the downside using the buffer, or perhaps we're just looking to garner the upside that we're comfortable taking risk with, but still buffering the downside or smoothing out those returns. Now, again, the big focus here is it is point to point, right? It's from day one to the last day. Your underlying index is still going to move between those 2 points, right? I don't get
Correct.
immediate protection every single day that I actually open my statement, but I know at the end of that term, the buffer will be there.
Right. And the last one I mentioned was behavioral management, and that really ties into all the categories we've talked to up to this point: nearing or in retirement, concentrated cash positions, high income earners that have a lot of risk on the balance sheet already. At the end of the day, these tools are or can be designed to help clients stay invested during volatile markets behaviorally, and also can help reduce the occurrence of panic selling. Good advisors, in my opinion, help coach the clients off the edge or off the ledge when markets get very volatile, because again, behaviorally, we want to fix things that seem broken. or things that are at risk. And so when the market ticker is showing a bunch of red, our immediate behavior is to, hey, I need to go sell and get out of this risk, to get out of the pool. That may or may not be the best opportunity to do so. And so these can help with that.
We've talked about, again, very basics before we expand the series into more specifics. Very basics about what a structured note actually is, some basic ideas about how they actually work, the components involved. We've talked about some common use cases where we see these actually get employed. You mentioned earlier in the episode that you walk into the hardware store or to Home Depot and there's 100 different tools on the wall. And for listeners who are kind of absorbing some of this stuff and saying, hey, like this sounds like a great tool, can I use this hammer in every circumstance? Let's talk more about risks, considerations, like things to actually understand before jumping right into, I want a buffer or participation or something else that this designed note is actually providing.
Yeah, I mean, these can sound exciting. Again, they can add an extra layer of complexity or sophistication to your financial plan or your investment strategy, but it's important to acknowledge that there are risks. One of the big risks is going to be liquidity risk, no different than if you had a CD or certificate of deposit. Liquidity risk in the sense that because it is point to point, you can't necessarily just put, for example, $100,000 into it and surrender it before the maturity date. Why? Because you're going to the issuing bank and requesting your money back from them before they're ready to give it to you because of what they're doing behind the scenes with the money that you've quote unquote lent them. So if you go and do that from a liquidity standpoint, yes, with structured notes, you can typically take it to the trading desk and see what it would be valued at. In some cases, depending on how the structured note is performing based on the underlying index, it could be priced above its par rate or what you gave from a contribution standpoint. It could be priced well below what you gave them as far as your initial contribution amount. So if you're going to surrender it early or sell it early, you could lose out on some of the return of principal. Example, let's just say I put in $100,000. It's a 24-month note and I've just poorly managed my finances and I need access to additional liquidity. Okay. If I surrender this, and let's just say month 9, there's a good chance that I may not get the full $100,000 back. Maybe it's $90,000. Maybe it's $80,000. I don't know. There's going to be some sort of negative trade-off for getting my money back before the actual maturity date. So that's just one thing to be mindful of and why we recommend not putting all your eggs in one basket and this being a satellite or complement to the overarching strategy as a whole.
So liquidity risk first and foremost, because similar to a CD, we're putting terms in place. What else out there do you find is a risk or consideration?
Issuer credit risk. So the banks that are issuing these all have different levels of rating as far as their score of how financially stable or risky they may be from a credit risk perspective. So you just want to make sure that the issuing bank that you're partnering with and that you're relying on to deliver at maturity, as far as the results of the promissory note or the contract, since this is a debt obligation, is sound. Now, just make sure you understand credit risk, the spectrum, and obviously the lower the credit risk, typically, if I understand correctly, the higher the potential outcome, but you're also warranting more risk. No different than if you go and only invest in small cap stocks. Historically, over long periods of time, small cap stocks have outperformed large cap stocks, but they tend to hold more volatility on a year-to-year basis as opposed to large cap stocks in theory, or at least historically.
And I think the concept there, we mentioned it earlier, is remember, your money's not invested in the S&P 500. Your money's at the bank. So it's the bank who's actually the one on the hook or obligated to return funds to you. So if I buy a structured note and that bank cannot effectively step up to the plate and return my money, right? It's not in the S&P 500. I can't just go sell shares of the index itself and get my dollars back.
Correct. Now, the other handful that I would, I guess, chime on or share is just complexity, as well as the caps, or at least some of the features and how these are being designed. So as far as the complexity piece, not all investors understand how these truly work. And so I am of the mindset that if you don't understand what you're investing in and how it operates, you don't have to be the engineer and understanding all the intricacies of it, but you need to be able to understand what the potential outcomes could be in a positive or negative or neutral manner. If you can't define that, then you should probably hold off on investing in it, because at that point you're giving up and putting all of your trust in your advisor, who's hopefully keeping your best interest in mind. And if things go sideways, you have a different issue in hand, maybe from a legal standpoint. Now, as far as the features on these contracts or the caps and everything else, if you were doing a shorter term note, right, we talked about the 1 year with a 12% cap. Well, if the market goes on a big bull run and it generates 20% return, but you're only getting 12, you could feel a certain way about your outcome. So you need to understand what you're giving up, what the trade-offs are in exchange for some of the muted volatility that you could be receiving.
Sure, it's understanding not only how the note is designed, but what opportunity costs exist within that design. It may be easier to conceptualize, I have a 20% buffer and a 12% cap. It may be harder to conceptualize, here's the opportunity that I'm giving up if I were to actually place my money in something like this for a specified period of time. So, Michael, what we've discussed up to this point, again, the basics of what a structured note actually is. 2, we've given some very high-level examples about how they work and some of the components involved. We've talked through some use cases and then some considerations or risks involved. As we begin to wrap things up and summarize here, in your experience from what we've talked about today, how or where would you see notes get used in actual application?
Yeah, so as I mentioned earlier on, I think notes are usually applied in application as a component or a satellite to the overall core investment solution, strategy, retirement distribution plan, right? It's a complement. It's an enhancement. It's an enhancement to improve upon the investor's overall behavioral with the potential outcome, or to act as a multiplier in potential outcomes to help the investor get to where they potentially want to be a little bit faster, right? If everything works in their favor. So that would be the first part.
And then I guess the follow-up question there is, hey, it is a complement, it's a satellite, it's a component of what we're overall building. Where do you see those satellites actually fit into particular buckets?
Yeah, I would say it's really going to be dependent on where the client or investor is on their overall financial planning journey. So it could be a conservative growth bucket. What do I mean by that? Well, if it's a 12-month note with a 12% cap rate and the S&P goes up 20% in a given year, well, it's more conservative in nature, right? Because you're not getting the full outcome, but you also have the 10%, 15%, 20%, or 30% buffer on the downside from a risk management perspective. So it could be a conservative growth bucket. We talked about the volatility management with the buffers, being able to have those guardrails and mute what's going on in between the lines from start to finish at maturity. It could be a retirement distribution income bucket to help enhance the amount of income that's being produced. What do I mean by that? Well, if we take, bonds, traditionally, you might be able to squeeze out a yield of what? Maybe 3.5%, 4.5% with bonds, depending on what the interest rate yield curve looks like. With this, some notes that we've seen come across, the docket could offer somewhere between 8%, 9.5%, in some cases 15%. It just depends on what the trade-offs are and what the buffers look like and what the terms until maturity are. So again, it really just depends. So to summarize, conservative growth bucket, retirement income bucket enhancement, volatility management and behavioral management bucket, and then a cash alternative bucket, right? If I have, let's just say, 6 months worth of liquidity as a dual income powerhouse household, and I feel like, okay, well, from a risk perspective, I just want to keep 3 months worth in a high yield savings account, put the other 3 months in a structured note for a little bit higher potential growth than what the high yield savings account's offering. There's an awesome alternative. The trade-off is the illiquidity for the period of time that it's in the note.
So if I summarize here, some of the themes where we see application is customizing and really defining what outcomes or experience actually look like, being more conscious of how to manage risks from a buffer standpoint, being more conscious of how to actually manage the behavioral decisions we're making as markets move up and down. And then I would say the last theme, again, hitting back towards that satellite type component, is just additional diversification type strategy.
Right. And I would say that most investors think investing is only about maximizing returns, but real financial planning, in my opinion, is that it's often about maximizing the probability of successfully staying on or in the plan and not deviating because emotions or negative behaviors are driving our decisions in a way that don't necessarily align with what we're trying to accomplish.
Yeah. And for the right client with the right portfolio, with the right plan, depending on their behavior, adding this type of strategy or defined outcome in place can make it easier to emotionally stick with a plan to try to maximize the mathematic, I would say, outcomes of how the plan's actually designed itself. Because realistically, we can build a plan like this with as much efficiency as possible, but it doesn't mean much if the client actually can't stick with the plan based on how it's designed.
Absolutely. So with that being said, structured notes are definitely one of those investment solutions or tools where understanding the details matters, and we cannot emphasize that enough.
And hopefully this episode has helped simplify a topic that often gets buried under a lot of financial jargon and product complexity.
If you enjoyed this episode, make sure to subscribe, leave a review, and share the show with someone trying to become more intentional with their financial life.
And tune in further for additional breakdowns as we continue to expand the series. If there's another financial topic that you'd like us to break down in future episodes, head over to www.genesiswealthplanning.com/AMA and submit your questions there.
Thanks for listening to Financial Fortitude, and continue being an extraordinary wealth builder.
Are you considering hiring a financial advisor? If so, be sure to listen to episode 1 of Financial Fortitude. In this episode, we discuss the reasons why many people choose to hire a financial advisor and highlight the key qualities you should look for in the financial professional you decide to work with.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities, products, and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerly's California Insurance License Number 4353077.
7237198.37, expiration 6/28.